Hello everyone, welcome once again. In this video we'll look into span margin, one of the important concept in order to have high returns. But before that, let's take one quote from Frank Clark. The more you learn, the more you earn. So happy learning. So as I mentioned, we'll be touching on a span margin concept in this video. So let's go into span margin. Selling options, particularly future options, involves a certain tolerance for risk. The weirdness of it, or even the possible returns, can seem frightening when you see it for the first time. The span margin system gives you the capacity to calculate the future option margin and is one of your biggest advantages in option selling. So, what is margin? If you traded options or future in the past, you are already comfortable with the notion of margin. However, traders who have so far restricted themselves to equities may not be familiar with it. Hugely different margin obligations are one of the key distinctions between stock and the future options. If you buy an option, you simply pay the premium and have the option. That is it. That is the arrangement, no margin. When you sell an option, you gather that premium, but now you can carry an open position with the possibility for loss. For this reason, the seller of a put or call is obliged to put some deposit to keep the position. The collateral is not a fee, it is simply a guarantee made with your money from your trading account. This deposit is also known as margin obligation. So let us understand span margin. You understood the concept of margin. So now span margin. The exchanges set margin obligation for each underlying future contract. But future contract, the margin is determined by a pre-defined rule. The principle in the future industry is known as the span system. SPAN stands for Standard Portfolio Analysis of Risk. Span is based on factors such as the time value left in the option, the extent by which the option is in or out of the money, and the volatility of the underlying contract. After a couple of months of selling options, you should be capable to approximate the margin of selling options in the future contract with which you are dealing. As a common rule, if the value of your option is veering away, so is the margin requirement. If the value of your option is rising, the margin requirement will typically rise as well, in phase with the option value. So what is the advantages of or the benefit of the margin variation? The upside of all this comes when the option weakens in value. This can happen as a result of either advantageous market moves or time deterioration. When the option value begins to drop, the margin requirement for that option declines as well. When this happens, these margin monies are freed from escrow and into your available fund for use in other trade. Your escrow and existing fund balances are revised on a daily basis to indicate the daily adjustment in margin obligations. What this means is that you can often use your earnings from a short option sell to fund other trades, even if you have not settled your initial position yet. You can find more details about span margin on the NSE website. Your broker can provide you margin specifics for the position that you want to take. Generally, all the broker platform has the risk administration system, generally we called as RM system, which is developed as a part of their trading platform. So unless you do not have enough margin with your broker, you will not be able to sell any option. We'll close our video with one of the quote from Thomas Stanley. Before you become a millionaire, you must learn to think like one. You must learn how to motivate yourself to counter fear with courage. Thank you for watching the video once again, and we'll connect in subsequent video. Happy learning.